Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 4th of July 2021. We all know that currency is being printed out of thin air at a rate of knots. But where's it all going? How can we assess the distribution of where it's going? And more importantly, any changes in how fresh cash is distributed? This is important to know because it does impact our investment decisions. Let's start by defining inflation. So I know there are multiple definitions of inflation. Here's just one of the simpler definitions. So this says that inflation is when the money supply exceeds the available goods and services. Let's drill down and look at each of these factors. This is the chart of the M2 money supply for USA from 1960 to present. Not only is it in a persistent uptrend, but also note that the money supply has never actually dropped. There are times when it was relatively flat. So for example, over here, and there's a little flat area here. But basically, it's never gone down in 60 years. Given that there don't seem to be any constraints on printing currency these days, I think that it's sure pretty safe to say that this trend is likely to continue. There are three main categories of places where printed currency can go. It could go to wages, it could go to consumer goods and services, but it can also go into assets. Now, I was hoping to find a pie chart showing just how printed currency is distributed among these categories, but I couldn't find such a thing. I couldn't find any charts that showed that. If you can source such data, then please do let me know, but my suspicion is that such information isn't actually meant to be freely available. So we're therefore basically going to have to work this out for ourselves. Now, one way of doing this is to look at ratios. We shall start with wages. This chart shows the ratio of wages to M2 money supply. So on this chart, a downwards move means that the money supply is growing faster than the wages are growing. You can see here that since the year 2000, the ratio has halved. We can deduce from this that less and less of the printed currency is going towards wages. So even though wages might be going up in nominal terms, new currency is being created at a much faster rate. We all know that consumer prices have been consistently rising over time, but this has only been a thing in the fiat era. You can see on this chart that before 1913, consumer prices were relatively flat and just moved within a narrow range. If we look at the ratio of personal consumption expenditures to M2 money supply, it looks the same as the wage ratio chart, doesn't it? The one that we just saw earlier. Although the price of consumer goods is rising, as shown from the last chart, M2 is rising at a much, much faster rate, and it has been doing so since the year 2000. That means that little of the printed cash is getting out into the real economy. And then we come to assets. Now, one way of looking at this is by looking at household net worth. For most households, their net worth will be in the form of real estate and stocks. This chart shows the ratio of household net worth to the M2 money supply. This ratio has been in a downwards trajectory since 2006. So this means that less and less of the printed currency is going towards household net worth. Maybe the currency is going towards making more loans. Nope. This chart shows the ratio of household debt to M2, and it's been dropping substantially since 2008. It's not even going towards commercial or industrial loans in significant amounts either. Here again, you can see that there was a huge drop in 2020 alone. Most of the general population, I think, have been led to believe that the printed cash is mostly for the government to spend on improving public services and infrastructure. This chart shows the ratio of total government expenditures to the M2 money supply. You can see that there was a sharp drop since 2010, and that shows that cash was printed faster than the government was spending. 2020 has seen large, wild swings in this ratio, and I think this is a particularly useful ratio to keep an eye on. Is the printed cash going into stocks? Well, the ratio of the S&P 500 to the M2 money supply has been on the rise since 2009. However, note that it hasn't reached the all-time high that we saw in 2000, so there is potential room for further upside in this. I don't think this chart gives us the whole picture though. Note that there are lots of non-US entities that print their own currency to buy US stocks with. So, for example, the Swiss National Bank has 20% of its assets in stocks. We also have several sovereign wealth funds all over the world piling into stocks. And although some of the sources of this currency will have been earned, say, for example, from oil, income from oil or other resources, but I'm pretty sure some of it will have just been printed. Ideally, we'd want a chart really that shows the global stocks to the global M2 money supply, but I couldn't actually find that. This chart looks very different from all the other charts that I've shown so far. Not only is it in an uptrend, but it's also at all-time highs. Yes, this is the ratio of the Federal Reserve balance sheet to M2 money supply. Now you'll see that the data only goes back to 2003. I would really love to get a longer term chart of this, ideally going back to 1913. That would be really interesting, but yeah, I don't know where to get that from. But this chart basically tells us that a greater proportion of printed currency is going towards assets on the Fed's balance sheet. What assets are we talking about here? Well, the Fed mainly holds US Treasuries, but it also holds things like mortgage-backed securities and other types of securities. So I know that they started buying junk bonds as well. In red is the Treasury to money stock ratio, and in blue is the mortgage-backed securities to M2 ratio. We can see that the Treasury ratio keeps making new all-time highs. And so it seems that the bigger and bigger chunks of cash is going to buy US Treasuries for the Fed's balance sheet. So far, I've focused on the USA, but let's look at a couple of other areas in the world using the same type of analysis I've used so far. This is the ratio of the European Central Bank assets to Euro M2 money supply. Now here data was only provided to 2017, and no doubt this ratio is likely to be even higher now. And I know that someone was unhappy that I was unable to get up-to-date charts for a lot of these things, but that's all that they provide. And that's one of the problems these days is I'm finding a lot of data is actually delayed more and more as well, and not just in the area of finance as well. But anyway, going back to this chart. So it looks like the EU have been upsizing their balance sheet size since 2015. Japan went nuts buying assets since 2012. Again, they only provide data here up to 2017, but note that the ratio was close to 3 back then. which is what the US ratio is right now if we indexed everything to the same date. I couldn't get the breakdown of these assets for Japan, but I think it's pretty safe to say that most of those assets will be in Japanese bonds. We know that the Bank of Japan also buys stocks, and they started buying ETFs in 2010. Since then, we can see that the Nikkei index to M2 ratio has slowly kind of meandered upwards. That's after the arrow shown there. The Central Bank of Japan now owns 80% of all Japanese ETFs. So it looks like there isn't much juice left there. In conclusion, I think we can conclude that the bulk of printed currency is going towards buying treasuries, and some of it's also making its way into the stock market, but probably indirectly. What's the reason for doing this? Well, it's to keep interest rates low, and I presume that that's in order to avoid widespread debt defaults. A decreasing proportion of printed currency is making it into the real economy. Those stimulus checks and government spending programs are actually just a drop in the ocean of printed currency. Next up, the market update. Let's start with gold priced in US dollars. This time we'll look at it on the weekly scale. And we've got this longer term trend line joining these two lows here, and that met up with this low here as well. So we've got 3 touches. And the question is, what do we do now? I think we need to hear from Kenny Rogers.
You got to know when to fold up, know when to walk away, know when to run.
Okay, so what do we do? Do we hold them? Do we fold them? Do we run? Well, I ain't running. For me, this is a hold 'em situation. Yeah, look, remember from everything that I've spoken about for over a year now, for me, that built a very strong case for gold. So there's multiple reasons. You kind of have to be one of those diligent ones who've watched all my videos to kind of really get where I'm coming from here. But I still think we're fine. I'm still bullish on this. And this last candle here had a nice long wick at the bottom. So that's a positive. I know this is a very nasty candle, but it doesn't mean it can't be reversed. But this is the line really that we need to hold. Now, if it breaks, is that a complete disaster? No, because of course it all depends on the timescale you're looking at, you know. I mean, even if it goes to 1300, it's still a higher low than it was, you know, back in 2016 even. So, you know, but of course, you know, most of us are going to be working on completely different timescales. So really, you've got to really hone in on what your goals are and what timescale you're looking at. So I'm a long-term kind of person. But even on these shorter timescales, I'm doubtful that that's going to break, to be honest. If it were to break, then the next target would be here, which is the bottom of this channel. So we're looking at, you know, into the 1500s. Oh, I just don't see that happening. But look, it's not impossible. I don't know for sure. In terms of the bullish case, yeah, we're looking for a reversal here. And ideally, we want to get back above this trend line over here. And particularly if we can get above that 1900 level, that's going to be a big, important level there to get over. What else could happen here, apart from those two scenarios that I've been talking about? Another possibility is we get more sideways movement, which would be very, very frustrating, but it could still potentially be bullish. So one other option is if we were to drop below this trend line, we could do something like this before moving up, in which case, you know, we'd have a kind of triangle shaped pattern here. which I would expect to break up to the upside. But the problem is that's going to drag on. That's going to take, another year at least, which I think a lot of people would get very fed up of. Also, that would break my thesis for, if you looked at my trajectory video, that would break that trend that with the parabolic trend that we were looking at. So I'm hoping that doesn't happen. That would be very, very, very frustrating. I still think we're going to go up this way, but I don't know for sure. Okay, let's move on to silver priced in US dollars. This time we'll look very closely at the hourly scale. And you remember last week I was talking about this triangle. And this is a great example of why charts can be very frustrating, but silver is also very frustrating. Silver is probably one of the more difficult ones to analyze in some ways because it does crazy things. So we had what looked like quite a nice triangle, and here you'll notice that it broke out downwards, but then it bounced straight back into that triangle. So that was a fourth breakout over here. And then finally it broke out downwards, but it didn't really meet the target. The target would be the height of this triangle here. And it didn't come even close to that really. It was a fraction of that before it bounced back upwards. And so then you got to ask yourself, well, was that actually a triangle? I mean, another possibility is that you've just got a rectangle, because of course when you look, these trading kind of content that you see on the internet, they show those perfect examples where you had the triangle and it broke out and it met or exceeded the target. But they never show you these ones where it didn't work out and it was probably not a triangle in the first place, So yeah, to me now, this would probably be interpreted as a rectangle. In which case, this is looking positive, because this could be, a rectangle that's moved back and forth. You had a partial decline, and then it looks like it's broken up to the upside and is just retesting the top of that rectangle, in which case we look for a further move up here in this direction. That's what I'm thinking there anyway. And if we look on the weekly scale, and this is another reason where I'm feeling very bullish still, because the model that I'm thinking of hasn't broken yet, So, and I think it's sometimes good to both kind of stand back basically, as well as looking closer inwards. So this is looking from kind of a longer standpoint. It looks like we've got this triangle forming, and this is a bullish triangle. So usually these ones break out up to the upside. We've had 3 touches to the top and 2 touches on the bottom. We haven't quite touched that trend line there, and price just doesn't seem to want to go there, which is also, I don't know, I think that's hopeful as well. And we've got this nice weekly candle over here from last week. So the other thing is also we've moved above this line here, the 26th line, which has been important resistance. So we've broken through that again. So that's positive as well. And we're back in this zone, which we've been in for a long time. Soon it's going to be almost a year. That's crazy. I didn't think it would last this long. So back in this zone here. And I think we're going to spend a bit of time here again. And then I think it's going to go up towards that 30 level. But that 30 level is going to be resistance, I think, as well. So to me, this all looks positive and bullish still. I'm not really expecting a downwards breakout here. Let's move on to the gold miners. And so this is the GDX on the daily scale. And I've kind of zoomed out a little bit to include the price action from March of last year as well. And you can see it's not really done very much. I think people are very bored with this. The price has just basically moved sideways that whole time there, and we had some hope here when it moved up here. We've dropped down. So far we haven't made a lower low, so that's positive, but we are still in a short-term downtrend here. So the question is that going to continue, or have we turned a corner over here? So there are a couple of things to kind of look at here. One is gaps, and remember that we've got this unfilled gap here, and that's quite a large gap there. It's kind of partially filled. And we've got another one above here, which is much nearer by, and I think it's going to want to fill that. But one thing that I still have in my head is this gap here. But, you know, the longer time goes, the longer... I mean, some of these gaps, there was a gap on the GDX that took 8 years to fill. So it doesn't mean that this is going to be filled immediately. Will it ever even get filled? Yeah, I don't know. I haven't really got my head around gaps completely, but I just have it in my head that they're things to be wary of. So there seems to be more gaps above than below anyway, and this is the much more immediate one. The other thing I wanted to show was the RSI. And one of the things here is that we seem to have a bit of divergence here. So we've had a higher low in the RSI here and a lower low in the price action here. The other thing is that we're already getting into that oversold kind of area here. And the last time we actually hit that white region was in March over here. It was a little bit deeper then, but between now and then, it never really got into that area. Can it move even lower? Can price go down even further? Yeah, I mean, this divergence can be negated. So, you know, just often take a lot of these indicators with a pinch of salt. You just got to put multiple things together to come up with your conclusions here. But what I would say is if price kind of doesn't move particularly strongly and just kind of moves sideways, what happens often with the RSI is that this starts to recover, and that gives room for it to move further down. So that's what we don't want to see, is price kind of meandering sideways. We want to start seeing an uptrend here. Okay, let's move on to the silver miners. And so this is the SILJ on the weekly scale, and this is the model that we're looking at, is this massive triangular structure here. And the previous times this trend line was hit here and here, you can see it didn't stay there for very long. It got knocked back pretty severely. Whereas this time here is quite different. We're spending a lot of time within this 13 to 18 price range here. And we are getting this kind of triangular pattern again as well. I mean, this could be seen as an anomaly there. But this bottom line has been pretty strong there. And so I'm expecting it to hold because price is spending too much time in this area. And if that does hold, that's going to be a strong kind of base forming, I guess. If price does go further up, what we're hoping for is it goes up here and through that line quite decisively. And if we look more closely, so this is the silver miners, the same chart on the daily scale. And again, so we've had this boring movement sideways. This time, remember I was talking about this gap over here? Well, it almost completely filled. It didn't quite fill it though. Does it have to completely fill it? If it doesn't, if there's a little bit left, does that matter? I don't know. But price never reached this bottom trend line this time. Is it going to drop further before it bounces up, or is it just going to move upwards? I think it's going to move upwards, but see, look here, we've got another gap here, which is closer, more immediate. And, you know, that was quite a strong emotional gap there. So, I don't know, I think that's going to want to fill again. And again, if we look at the RSI, that was getting into that oversold territory, and the last time it got lower than that was in March last year over here. And just looking back here, this is an example of that thing that I was talking about with RSI potentially being negated. So here you can see that it dipped into the oversold area over here, and then it kind of moved sideways a bit before moving downwards, and then we got an actual lower low in the RSI. So that's just something that you've got to be wary of. I don't really use RSI a huge amount, but it's just another thing to add to the mix, I guess. Okay, and then this is the SILJ to silver ratio. And so we've been looking at this. And so a downwards move means that the silver miners are underperforming silver. And so that's what's been happening in the last few weeks, really. We are in what looks like this triangular formation. It kind of just poked above that line here, but didn't really close above it. And here it poked below it, but didn't really close below it. When's this thing going to break out? Well, already we're 75% along the way of this triangle. And so the further along this triangle it goes, the stronger the breakout's going to be. I think this is going to break out upwards, but we shall see. Only the market knows, and only the market will tell us. People's opinions don't really matter. The market doesn't care. So yeah, that's one thing to be watching out for as well, as an upwards move in this ratio and a breakout. Actually, yeah, we've got to be aware that it could break out downwards, and so just watch for that. If you see a close below this line, then get very, very worried. If you see a close above that line, get super excited. And I just wanted to end with a question for you all. So this is the S&P 500 on the weekly scale. And again, we've made another all-time high. This thing is like a juggernaut. It just keeps going up and up and up. But I was just thinking the other day, I'm not really sensing euphoria with these highs. I mean, I haven't had any random people come up to me and tell me to buy certain stocks or whatever. Over here it was interesting because the week before this crashed, I had someone at work who normally has no interest at all in investment or whatever, started telling us about how they're piling into their investment, their retirement investments and so on. And so that kind of caught my attention, but I haven't had anything happen around here. And you know that whole thing about the shoe shine boy, and even nowadays that's been converted to Uber drivers, but apparently I'm not allowed to say Uber drivers because apparently that's very offensive. So some people didn't like that. So I'll just say random people. You know what I mean. But basically, I wanted to know, I mean, it might just be because I'm isolated out here in New Zealand, but is anyone, particularly in USA, is anyone getting the sense of euphoria by regular people around them? I think that would just be interesting to know. I'm not getting that sense, which tells me that maybe this isn't the top. I don't know. I'm not a super expert on the S&P 500, so take it all with a pinch of salt there. So that's it for me for this week. I came across a couple of very amusing things actually during the week. So they're both relating to silver. So I came across one guy who was saying how even if the Sprott Group bought 1 billion ounces of silver, the price of silver would still be $25.99. It's kind of been that price for what feels like ages now, hasn't it? Anyway, I thought that was quite amusing. It's kind of tragicomedy, really, isn't it? If you didn't laugh, you'd cry. And then the other one was where the spot price of silver is $26. So a guy goes into a coin shop and asks the dealer, what's the best price you can give me for an ounce of silver? I want to buy an ounce of silver. And the guy kind of rubs his chin and goes, oh, look, the best price I can do is $149.50. Anyway, with that, I shall say goodbye until next week. Don't forget to like and subscribe in the meantime. Bye.